Have you ever thought about what it would be like to be an extraordinary wealth builder? We often throw this term around on our Financial Fortitude podcast. Brady and I like to discuss what it actually means to be saving at a higher rate, right? Something greater than average, because let's be honest, we weren't built to be mediocre or average. We were built to be extraordinary, okay? And one of the things that we often discuss with our clients is, are we saving enough, right? What is our personal savings rate? What is our 1 rep max? And so I want to walk through this scenario where we take an average saver and compare them to an extraordinary wealth builder, or an EWB, if you will. Well, let's first figure out, what does the landscape look like, okay? So as of today, based off of data from the Bureau of Economic Analysis, in October of 2024, the personal savings rate across America was about 4.4%. And again, this is disposable income that's available to be able to save back on our balance sheets. Now, that's not a lot, right? 4.4% is very low. It's setting the bar very low. So again, we weren't built to be average. We were built for extraordinary opportunities. So let's walk through an example. So let's say we have a 30-year time horizon, and this household or investor is earning about $150,000 a year. Let's assume that they get a raise of about 3% annually. Well, if we're saving at 4%, that means about 96% of our annual income is going to other things like taxes, debt, and lifestyle. So I'm just going to park it here in lifestyle. Annual savings rate of 4%. Over the course of that 30-year time horizon, we end up keeping about $285,000 for ourselves before any sort of return on investment, right? The first argument we often hear is, well, there's no return on investment. I'm sure I would be making some sort of money. Well, that's true. And so my first question would be, what do you think is a reasonable rate of return in the stock market over the course of 30 years? Often individuals will say, well, what has the S&P 500 done, right? The S&P 500 is the most referenced benchmark in the US. Well, on average, if we look at Morningstar data, the S&P 500 on a 10-year average has returned a little over 10%. Now, again, this is an after-tax rate of return. So if we're netting a 10% return and the national advisory fees come in around 1.5% to 2%, that means that we need to be generating about 11.5% to 12% annually to be able to net out a 10% return. Well, let's look at the outcome. Well, for this average investor, they end up keeping about $1.416 million as they exit the workforce and head into their retirement. That's not too shabby, right? And what they've effectively done is 5x what they set aside through their 4% savings year over year if it would have just sat in cash. And that's just based on the effects of compounding interest time and time over 30 years. Okay. Now, one thing that we're doing, 30 years worth of investing, averaging a net return of 10%, is taking on a ton of risk. We're leaning very hard into equities consistently over 30 years. May not be problematic for some investors, right? Now, what if we did something a little bit different? What if we were extraordinary wealth builders? Meaning that instead of saving the average of 4%, we actually saved somewhere between 15 to 20%. Meaning that 80% of our gross income was going toward things like taxes, debt, and lifestyle. And we were guaranteeing 20% of our earnings back on our balance sheet as opposed to the balance sheets of others. Well, we know for average, we're going to end up with about $285,000 in just cash reserves. Well, if we can save 20%, we actually end up with about $1.427 million in cash reserves. How powerful is that, right? We basically 5x your outcome without taking on any market risk. Why? Through disciplined habits of setting money aside. Now, in this scenario, because we've already ended up 5x times where we were in the previous average scenario, what if we had an average after-tax return of 5% year over year, meaning that our gross return was probably somewhere between 6.5% and 7%. Over the course of those 30 years, that $1.4 million ends up being closer to about $2.984 million minimum, right? That is massive amounts of wealth that we get to look forward to just by being more disciplined with how much money we set aside for ourselves. Now, what this ultimately means is that, one, we took on less risk. Two, we guaranteed more for ourselves based on our own efforts of putting money back on our balance sheet as opposed to the balance sheets of others. And we relied less on hope and risk, right? Because the average investor who's only saving 4% is going to be relying heavily on higher returns and taking on more unnecessary risk, which in my mind could result into a less attractive, less enjoyable ride over the course of 30 years. There could be more bumps on that road trip, meaning more volatility. Now, at the end of the day, I believe that markets are optimal and that we're going to see market upswings and market downswings. We just don't know how long they're going to go up for and how deep they're going to go down and how long they're going to go down. So by focusing on the things that we can control, which is how much money we put on our balance sheet as opposed to the balance sheets of others, we are giving ourselves the potential for higher wealth, especially if we can do it at an extraordinary wealth building potential. Are you up for the challenge?